as I tell people, tax avoidance is clever, tax evasion is criminal. So,
don't do it.
Important distinction.
What if one mistake in a 1031 exchange could cost you hundreds of thousands of dollars in taxes? Because here's the truth most investors don't hear early enough. Most real estate investors don't lose money in bad deals, they lose money in tax strategy mistakes. And today we're talking about one of the most powerful and most misunderstood wealth tools in real estate investing, the 1031 exchange. If done correctly, it can help you defer massive capital gains taxes and accelerate long-term wealth building. If done wrong, it can be instantly turned into a full taxable event. And the scariest part? Well, most people don't realize they've messed it up until it's already too late. So before we dive in, one quick thing. You'll see a QR code on the screen here and again at the end of the episode. There's no pitch behind it. It simply takes you to a page where you can schedule a conversation if you have questions, want advice, or need help thinking through a real estate decision, whether that's buying, selling, or just planning next steps. No pressure at all. Just a resource if it's helpful. Today I'm joined by someone who lives inside this world every single day. Attorney and exchange specialist, Martin Burns. Martin, I'm really glad to have you here with us today.
All right, glad to be here.
All right, so before we get technical, I want to share something personal. Because this isn't theory for me, Martin, you were involved in one of the most important transactions of my career. You were the intermediary on an exchange where I was repositioning assets, taking equity from a couple of rental properties originally and turning them into the down payment for the building we're sitting in right now. It's a big deal. This was my very first and actually only commercial building I currently own. But at that time, it was a big deal for me, and that wasn't that long ago, back in 2022.
Well, I'm glad I was playing that part as opposed to the lawyer part suing you or something, but happy to be the qualified intermediary on that one.
Yeah, it wasn't just a transaction, it was a trajectory change for me. And I think that matters for investors watching because this isn't just tax strategy, it's also wealth strategy. So let's start here. What originally pulled you toward real estate law?
Well, yeah, I practiced at other areas. When you start as a young lawyer, you do kind of door law, whatever comes through the door, that's the type of law you're doing. But quickly, a lot of it just didn't make sense. And I didn't want to do that for my career. I mean, family law seemed to be high-priced babysitting, and personal injury, I didn't quite understand, why you'd get $30,000 because your shoulder was sore or something. So real estate made sense. Just putting together transactions, taking apart transactions, contracts, those sorts of things. And I do enjoy litigation, and there's no shortage of litigation with regards to real estate. So about, 5-6 years in, met up with a guy named Ed McFerrin, who's an attorney, and he does 1031s as well. I met up with him, and I worked with him for, a good 14 years. And he largely did real estate, and I enjoyed it, and later broke off and opened up my own companies. So, yeah.
That's awesome. So how does your accounting and legal background change the way you structure exchanges compared to a typical real estate attorney?
Well, most of the real estate attorneys don't do exchanges. They don't understand them. I used to have a CPA certificate, but I've never really practiced as a CPA. I've always practiced as an attorney. But it's helpful because the threshold question on pretty much every exchange is, do you need one? And so I walk through with people as to what they purchase it for, what their basis is, what sort of gains they're looking for at, what sort of taxes would come from that, and make sure that the exchange is viable. Also, we look at how the property is currently owned. Is it in an LLC? Are there other partners? Do they want to stick together? Do they want to go their own ways? And I can help with that kind of on the legal side because I'm allowed to do legal work incidental to an exchange. Typically, your attorney is not your qualified intermediary. And we've got separate companies, but at the same time, we can do legal work incidental to an exchange. So there's times where sorry to say this, there are transactions that don't have brokers involved, and we can put together a purchase and sale agreement. Or we can break apart LLCs, kind of called what they call a drop and swap. You drop out of partnership, the LLC, and then move right into individual exchanges. So we can help with that, where a lot of other traditional exchange companies don't do that. And frankly, a lot of them just say, go talk to your CPA, go talk to your lawyer, whereas, we're kind of more the Fred Meyer one-stop shopping. So yeah, but yeah, it helps, and we've been doing them for, 25 years. So you get enough of them under your belt.
Well, with that, have 1031 strategies changed since you first started?
Not much. I mean, the law's been around since, I think, the 1930s. The only big change that's come up, and it really doesn't impact most people, is that they've gotten rid of the personal property exchanges. And those were quite limited. You sell a jet and buy another jet, or they can do it with artwork and stuff. It was a very minimal part of the exchange world that I was involved in. So from a 1031 perspective involving real estate, very little has changed. The rules have remained the same for quite some time.
Wow. So let's bring this down to street level. Most investors hear 1031 exchange and think complicated, risky. So simplest version, if you were explaining a 1031 exchange to a brand new investor over coffee, how would you explain it?
Well, first, there's no big risk. People do call up and say, well, is this legal? It's like 1031 is the section of the tax code. So yes, it is legal, and it's been legal for years. But really, it's designed to help people move up in investment and commercial use property. If you started a little business in the garage and then moved out to a little shop and then bigger shop and then a warehouse, as long as you're moving up, you haven't really taken the benefit of the gains. You're rolling them into a bigger business, and the tax code, on this one instance, is somewhat rational and doesn't tax you as long as you're moving up and not taking the benefit. And it works for small investors too. You buy a single family residential rental, you rent it out for a while, you decide, hey, I'm going to sell that and buy a fourplex. Boom, then we got an eightplex, and people are just growing their investments. So it's really to be used for investment in commercial use property. It's not for primary residence, it's not for vacation homes, but as long as you're moving up in value, you can defer the tax and roll it into it. And that's kind of where we come in, because what the IRS says is if you take control of the cash, if you run your hands through the money, you've accepted it, because there's two parts to a gain. There's realizing a gain and recognizing a gain. And recognizing it is, you'd realize it when you sell it, but you recognize it when you take the benefit. Well, we block that away. We step in, block away the money so you don't, and then we fund it into the acquisition property. You've never touched the money, never recognized the gain. So it works at all levels. It works for small, it works for big ones. And when you got tax rates, 15% is about the lowest you're going to have in a 1031. It goes up to 20. And if you're above certain income levels, it can go up to, you can get the Affordable Care Act charge. It's the Obamacare spiff, as I call it, but that's another 3.8%. So you can be up close to 24%. So the exchange can provide some pretty valuable benefits, I guess. You just have more cash, more liquidity. You get a larger loan if you want to expand faster. So, yeah. So sitting over coffee, I'd say it's for everybody.
So what are the biggest rules investors must understand before they sell?
Well, there's three main rules as the exchange goes on. First, it has to be like kind. So that's investment or commercial use. Now with real estate, it's quite broad. It can go from single family housing to skyscraper to industrial to developable dirt. There's some issues if you're a developer and that's your inventory. You can't do that if it's in trade. But if you're just buying investment property, it's got to be real property. When we don't really care so much as what's on top of it. So first is like kind. The second is spend all your cash. So if you come out of a transaction and you've got $500,000, well, you got to roll that into the next property. If you don't, let's say you say, well, I really need a new car and I'm pulling 50 grand out. You can do that. but it's going to be a partial exchange, and you're going to pay tax on that $50,000 that you took out. And similarly with debt, it's don't have debt relief. So if you had $500,000 in debt on the relinquished property, you're going to have $500,000 or more of debt on the replacement property. Again, if you come up short on the debt, it doesn't disqualify your exchange. You just kind of pay tax on that delta, the shortage there. So, like kind, spend all your cash, don't have debt relief. Those are the big 3 rules in the exchange, and then you get into timelines.
So this is where people start sweating. I always tell investors, day 45 is where exchanges go to die. Can you walk us through the 45-day identification rule and the 180-day completion rule?
Sure. I'll take it backwards here. The 180-day rule, and these are hard and fast rules. You don't get to apply for extensions or things like that. It's deed to deed. So when you sell that other property, the relinquished property, you have 180 days total to get a deed for another property. Now within the 45-day rule, first 45-day rule, you're supposed to identify property to, typically it's the qualified intermediary. The rules actually allow you to identify to others, but it's typically to the qualified intermediary. And you can change that list up through the 45th day. But on the 45th day, when you hit day 46, it is as if it's been etched in stone. You're not supposed to change that list. But most of the time, people are well under contract. I would say a good majority of our exchanges actually complete within the 45-day rule. You want to, if you're looking to do an exchange, as soon as you get under contract, you should be looking for your replacement property. And it's not uncommon that people are already under contract prior to the relinquished property selling. And we've had times where we don't even have the time to bring the money into our account. We're just directing it to go to the next escrow because people have lined them up so close. But you have to sell first in a normal exchange, then purchase. So the 45-day rule, it's kind of a dumb rule, I kind of think. I don't know why the IRS just doesn't say get it done in 180 days, but you're supposed to do it. It's supposed to be in writing, it's supposed to be signed, delivered, it can be changed. So the other thing we do is, as we're tracking these exchanges, if people aren't under contract as they're coming up to their 45th day, we're calling them saying, what are you doing? You know, do you want to terminate the exchange? Because we can only give the money back about a couple times. At any time in the exchange, it can be used for replacement property. But you can't just walk into our office and say, I changed my mind, give me the money back. You sign a contract that says we can give it back to you when the exchange fails. Well, the exchange fails on the 46th day if you haven't identified property. So if you want to terminate an exchange, you make sure you wipe off your identified property list so when we hit day 46, we can give you your money back. Otherwise, we're out to the 180th day in most situations. There's an exception that if you file your tax return, like right now, I mean, someone could terminate that 180 days early by filing their tax return, but that's a little bit unusual. But yeah, 45 days, it's a strict rule. IRS has only shown flexibility, I think, when the Hurricane Katrina, when California caught fire a couple of years ago, and they made some special rules around COVID. But that's it. I mean, it's a hard and fast rule.
All right, hey, that's good, great information. So why do so many investors misunderstand how those timelines actually overlap?
Well, there's a couple of things. One is they add the 180 days to the 45 days, and that's not the case at all. Other things that come up is there's just a misunderstanding of when the timeline starts. Some people are, well, is it when I list it, when I get under contract? No, the IRS doesn't care about that. It's the deed to the deed. So it's pretty straightforward.
Is that the most common mistake that you see?
Oh, in exchanges?
Yeah.
Well, I mean,
or timeline mistake?
Yeah, I mean, it's the 45-day identification. I mean, if you're not going to find enclosed property within 180 days, there's other things going on. So yeah, people getting up against the 45th day, and you don't really want to go past the 45th day without being under contract, because at that point, there may be only 3 properties in the entire nation that you can purchase to successfully complete your exchange. That doesn't give you a lot of leverage as a buyer with the seller, particularly if you let it slip. Yeah, the 45-day rule is just something to be aware of. And we send out letters and we call and we remind people and we ask what's going on. But let's just start early. If you're getting under contract on your replacement, get going on finding a replacement property.
So what's the closest you've ever seen someone come to losing a 1031 exchange, and what happened?
Well, I mean, we've seen people not find property. That's happened plenty of times. Perhaps one of the most unique ones was, it was a large transaction where they only used the address on the purchase and sale agreement, and the title and escrow only used the escrow and pulling title in the title report, and the deed only showed one property because they went off the parcel number for that property. Well, the interesting thing was there was 4 parcels, and it didn't become apparent to anybody until the tax statements came out the following year, and on 3 of the 4 parcels, well, there was the old taxpayer still on there. Those hadn't been done. And of course, it got corrected. And that's not us. That's not our part of it. But legally, it got corrected where they, the deed was re-recorded with the proper information, but those other 3 lots were conveyed outside the 180 days. And what happened was the title and escrow company had to indemnify the exchanger to any possible tax repercussions that could come of it. And I don't think anything did come of it. So, but that was unusual, that one. But it was, this puts me into another completely different topic on putting my lawyer hat on and purchase and sale agreements, is put the entire legal descriptions down for the parcels that you're selling, because it don't work off of an address. And this was a large transaction. It was, there was nothing for us to see. When purchase and sale came in, it had an address, had a parcel number. We got the title report, had the address, had the parcel number. No one asked if there was any other parcels that go along with it.
The devil's in the detail.
That's right.
And the devil comes after you when you mess up.
Well, and in all honesty, both the buyer and seller should have figured this out too. So that was a close one.
So what usually kills exchanges more often? Planning issues, financing issues, or misunderstanding the rules?
Well, there's different things that happen. I mean, we get a call every month or so of someone saying, hey, I just closed escrow. I want to do one of those 1031 exchanges. And well, too late. You've already taken control of that money. Can't do it. And those are always kind of sad discussions. So that's probably the most common one, is just not understanding that you need to have the qualified intermediary in place prior to the sale of the relinquished property. The other things, and I tell people this all the time, is don't make a bad investment decision simply to satisfy the 1031 exchange. You've got to gain. It's one of these congratulations, I'm sorry situations. You got to gain, don't blow it on a bad investment. So the other things where exchange fails is people can't find a suitable replacement property. And we tell them, well, again, don't force a bad investment. If you just can't find it, recognize the gain, pay the tax. Congratulations, you got to gain. So those are the 2 big ones that we see, is not having the qualified intermediary in place and not finding a replacement property.
How early should investors really be planning?
Obviously, before you go to escrow on the relinquished property, I typically tell people to get a qualified intermediary in place about the time that they're starting, to get the property listed. For instance, we don't ask for money up front. We get paid as the money flows through the qualified intermediary account, so there's no real big disadvantage of getting signed up early. Obviously, there's a big problem if you get signed up too late. But the other thing is, you want to be you want escrow to know about this early, because we do have situations where people call us from the escrow office saying, hey, we want to do one of these exchanges. Well, I mean, that leads to extra fees at escrow because they have to redraw their documents. There's expedite fees from us typically on those situations because it's a fire drill. We drop everything else we're doing. But if you just call prior to getting the property listed or about that time, we just walk through it, make sure that an exchange makes sense for you. I walk through the numbers. What did you buy it for? How long have you owned it? What are you selling for? What are your improvements? And I do a kind of estimate where you probably have a capital gain. I do ask that you go check with your accountant because they should be tracking your adjusted basis and tell more easily. But just get it going early. There's no downside to it. If you decide not to do the exchange, we don't get paid until an exchange gets, the relinquished property sells.
So strategically, it's just a great idea to have conversations with someone like you prior to, just right when the thought of listing a investment property comes to mind.
Yeah, we have this all the time. I mean, people call me up and say, hey, I talked to you 6 months ago. Okay, we want to move forward now. Yeah. So there's no harm in talking, and just, you call up and then I call back. So it's always me. It's in the evening. It might be during the day. I've got other stuff going. I just finished a jury trial, waiting for the verdict. But we call back, sit there, walk through the numbers, give you the kind of the rundown how the exchange works if the person hasn't done one before, and we send out the contract to review. And then the biggest thing we tell people is, we don't read minds. When you get under contract, tell us. Because what we need, the next piece of information we need after we get the exchange going is we need to know who escrow is on the replacement property. So then we start drafting instructions so that it's structured as an exchange as opposed to a sale.
A lot of the real estate investing I've done has been more short-term renovation for profit. So I haven't had an opportunity to do very many 1031 exchange. In fact, just the one that we did together.
Well, and we get that call a lot from the flippers.
Yep.
And that really doesn't qualify for an exchange because you're not purchasing it for investment or commercial use, you're purchasing it for resale. And you might get away with it if your first one takes a long time, which I know a lot of flippers, their first one takes a long time. And if you straddle a couple tax years, but if you go from property A to property B to property C, and they're stacked up on one tax return, it doesn't take the brightest IRS agent to figure out what's going on here, and that this is your inventory, much like a Twinkie to 7-Eleven. This is not commercial investment use, and so you get disqualified. And similarly, the large developers, they can't, when they sell a lot, to somebody or a house to someone, they don't get to do a 1031 exchange. This is their inventory. So it's for property used for investment and commercial use, simply put. And which, by the way, there's a new issue coming up with all these VRBOs and Airbnbs, where they're investment properties to a certain degree. But if the people are using them themselves, I think there may be some issues coming down that way, because the IRS doesn't have any hard and fast rules on that, but they do on depreciation. And if you're using it more than 14 days out of the year or 10% of the time it's rented, whichever's greater, then you don't get to take depreciation, which seems to be the rule that would parallel for whether it's being held in investment or commercial use. And I used to kind of laugh about it, saying, well, I don't know how the IRS would ever know. But with the VRBOs and the Airbnbs, you got to block off your time, I understand, and if you're the owners and when you're going to use it. And so there would be a record.
And with AI now, the IRS are getting a lot more efficient.
They may be. Got a family member who's a CPA that says they're backed up beyond belief. But regardless, as I tell people, tax avoidance is clever, tax evasion is criminal. So,
don't do it.
Important distinction.
So how important is debt replacement and structure matching in a successful exchange?
The debt is interesting. You can replace debt with cash. So if you sold something that had $600,000 in debt and you walked out of it with $400,000 in cash, you could get a $500,000 loan, take the $400,000 in, and then go look in your bank or your seat cushions or whatever and get the other $100,000 and put in. That's perfectly good. You can put in more cash into the exchange. You can't go the other way. Now, on that example, you couldn't say, well, I'm going to take $100,000 out and get a $700,000 loan. That's what they call mortgage boot. And that boot is kind of the term if you take cash out or have debt relief. And as I understand it, it goes back to if you had 2 horses and you traded the horses. Well, you really didn't have any appreciable gain. You had 1 horse, now you got a different horse. So there's no taxes. But if they threw in the boots with the horse, well, now all of a sudden you've got a benefit. And so you pay tax on the benefit, the boot. So the big thing with debt structuring is, yes, you can decrease the debt so long as you put the cash in. If you just use the same cash and you decrease the debt, you're going to have a partial exchange and you're going to pay tax on that difference, as we were talking about earlier.
So let's get into reverse 1031 exchanges. Sometimes in real estate, the deal you want shows up before you're ready to sell. Can you explain what a reverse 1031 exchange is and when it makes sense?
Yeah, it's like a normal exchange, but it's backwards, simply put. But essentially what we do is we buy the property. Now, you provide all the money, financing. We can sign the note and deed of trust, but we're not signing the personal guarantee, I'll tell you that much. But we take the property and we can park it for up to 180 days. And at the same time, you have to identify in the first 45 days which property you're selling, which, by the way, is pretty darn easy. Most people, it's that one right there. And so we hold the property. We have a master lease with you that allows you to do whatever you want to do with this property. Your fee for being the master lessee is you get whatever rents come out. So we're not pulling in the income. We're not managing it. We're parking it. And so you've got 180 days to get another property sold. And then once that property sells, well, then it's kind of like a normal exchange at that point in time, but the money comes in, we pay back the loan that we borrowed from you to buy the thing in the first place, and we complete the exchange. The difficulties with reverse exchanges oftentimes are the financing, because a conventional loan isn't going to do this. We aren't going to, if you go out and get a conventional loan, they're not going to loan to an LLC. And so for each of these exchanges, we form a new LLC, we hold the property in it, and at the end of the exchange, we hand over the LLC with the property in there. So you do get the benefit of the LLC, but conventional lending is generally not going to lend, your standard Fannie Mae, Freddie Mac, 1 to 4 family homes is not going to loan to an LLC. And then there's issues of transfer of beneficial interest, due on sale sort of situations that could arise. So typically, if you're going to do this, you're either going through a bank and it's going to be a portfolio loan, one that they're going to hold, or you're getting a bridge loan, or you just have the money to hand over to us to buy the property in the first place. So they are more expensive, both on the exchange side, because we're forming LLCs and doing other closings, and they can be more expensive on the financing side, because if you get a bridge loan, you're going to have 2 sets of loan fees and things like that. But we certainly can do it. We tell people to try to structure their transaction to not be a reverse exchange, but if you have to, if it's the deal of a lifetime, if that seller is not going to wait, we can do it. And we do a fair amount of them.
So you'd say that the reverse exchanges are usually driven by timing?
Yes, absolutely. If you can get your seller to wait until you get your other property sold, and you see that a lot with the contingencies, the contingent on sale forms that get onto purchase and sale agreements, and we're seeing more of those as the market has shifted some away from a seller's market. If you can push it out, great, but if the seller says, no way. I've got my own thing to buy or whatever. Yeah, then we're talking reverse exchange.
So what are the biggest misconceptions or risks investors should understand with reverse exchanges?
I mean, it's just the additional costs. Realistically, you're going to get your property back. I haven't kept any in 25 years. I don't want your property. And we have contracts and you have security. I mean, we have it all documented quite well. But the other risk is that I guess you don't get your loans and you can't complete the exchange. But I mean, you'd know that pretty early on. I guess you wouldn't be acquiring your to-be acquisition property, the parked property. The LLC we create is called an exchange accommodation title holder. And it sits in there and then we hand that over to you at the end. But if you can't buy the property, you can't get the financing or the cash to buy that up front, well, then you got another problem. And sometimes what people just have to do is buy the property with conventional lending and forego the reverse exchange. And then they sell the other property and either decide to do a forward exchange into something else, or they recognize the gain and pay down the loan that they had, to acquire the property in the first place.
So let's pivot to another exchange, an improvement exchange, sometimes called a construction exchange. Can you explain what an improvement exchange is and when it actually makes sense?
Well, it's similar to the reverse exchange. We're again parking the property. The thing with the improvement exchange is it has to be like kind. So it's deed for deed. Now, if you say, well, I'll take the property and then I want to use the money for a roof and some driveway and stuff. Well, now we're exchanging real estate for shingles and concrete and nails and things, and those aren't like kind. And so we can't take the money in the exchange and just go down to Home Depot, after the exchange is complete and spend the money. So what we have to do is park that property. So we buy it, and so we got the same issues with the reverse exchange as to acquiring the property. And then once we buy it, well, you're our construction manager, master lease. You go to Home Depot, you go hire the contractors, you go do these things. Now, but the practical problems with regards to these exchanges are you have to get it done within the 180 days. So if you're planning to pull permits and stuff, that's the biggest problem with these exchanges. Is if you're in a jurisdiction, let's say Seattle, and you want to go get it all done in 180 days, good luck.
Right.
So
seems like everywhere permit timeframes are a huge pain point all across our Western Washington, really.
Yes, and we're finding they work well if what you're doing doesn't require a lot of permitting or things go faster. You're replacing windows, a roof, things like that. But if you're planning to get a foundation poured, that's building permits, and that takes time. So the exchange, that's the biggest timeline, and you're supposed to have those improvements done. Okay. It's not enough just to pay the contractor. So when people do that, they run a risk.
Is there a consultant that verifies?
No.
Okay.
No. You just run the audit risk if you don't. And we don't go out and inspect either. We could be doing an improvement exchange for someone in Mississippi. I don't fly down and walk around and play, building inspector. But it works better on things that don't really require high-level permits.
Okay. So when would you tell someone not to do a 1031 exchange at all?
Well, I mean, that's kind of why we screen people. We walk through the numbers. And there's times where the people just don't have that big of a gain. They've done a lot of improvements on it. And so we say, look, you've got $10,000 of taxes you're looking at, but you're going to spend somewhere around $1,400 for an exchange. But remember, a 1031 doesn't get you out of the tax. It's a defer. It defers the tax. So do you really want to spend this amount of money to defer this amount of tax? It becomes a business rule judgment. There's other things we screen for too, is do you really even need an exchange? For instance, if someone has died recently, a lot of times the person calling has a stepped up basis. Because when, say in a community property state like Washington, and if husband and wife own the property and one of them dies, the basis in the property steps up to the fair market value as of the moment of death. So when the surviving spouse goes to sell, their capital gain is only going to be that little bit from the date of death to when they're selling it. They don't need the exchange. They don't have a capital, well, I mean, they kind of have a capital gain, but from a tax perspective, capital gain is your net sales price less your adjusted basis. Well, their adjusted basis has been stepped up, so they don't need it. And again, the other one that we screen for a lot is, and we just tell people, don't make a bad investment decision simply to satisfy the 1031 exchange. Again, congratulations, you got a gain. I'm sorry, you got to pay the tax. So we do that. Other ones, vacation homes, people, secondary homes, things like that. Those don't qualify. They got to be rental property. So there's times people want to try to do exchanges on those, and we say, go talk to your CPA, get his blessing, get her blessing, then come back to us, because I'm not going to tell you that that's the way to go. Now, we don't second guess the CPAs. They're the ones putting their name on the tax returns, but that'd be kind of dodgy in my mind.
So I want to shift this for a moment, because this isn't just about investors. It's also about real estate brokers who represent them. From your point of view, what is the real estate broker's role and responsibility when representing an investor in a 1031 exchange?
Well, the first one, and by far the biggest, is to recognize the possibility that your client might need an exchange. And we do get these calls where people, hey, I'm just closed, I want to do an exchange. And we explain you can't do it. And they're like, why in the world didn't my broker tell me that?
So there's some liability with that.
Yes, I've looked into that. The liability could be there. I haven't found a lot of cases on it. And I think part of the reason is that the dollar amounts aren't that huge that they could be settled. Also, there's two different lines of thought of paying taxes or damages. There is some Supreme Court authority that says you're entitled to arrange your affairs to minimize your taxes. But you do get benefits from taxes. You get battleships and tanks and jets and roads and police and things like that. So the courts have been somewhat reluctant also to say taxes are damages when that's what pays the judge's salaries. So there could be liability there. And I would suggest that brokers send an email to their person to document it, document, you're lawyer proofing your file.
100%.
But just say, hey, this is a rental. You should go call this guy, Martin Burns, and
Yes.
he's a qualified intermediary. Go talk to him.
By the way, his contact information will be in the description.
Thank you.
Yes, sir.
But to identify, that there's an issue, tell them to go look it up, check it out. And the other thing is to tell them, do it now. Don't wait until it's over. Because we've had people come in and say, yeah, no, I talked with the broker about it. He said, yeah, don't worry about that. Just, give them a call after it closes. No. Get us in place early on. So that the broker's role after that is to keep us in the loop. And it's also the exchanger's duty as well. But as I said, we don't read minds. So once you get it under contract, just drop us a text, an email, call us, say, hey, so-and-so over at First American, Chicago, Aegis, whoever, is handling the escrow. And then we contact them, we get a copy of the purchase and sale. We generally get it from escrow, so we're all playing off the singing off the same sheet of music, so to say. We get the title report, which I review all of them, and I look at who's the vested party. And I also check to make sure it's real estate. There have been times that's been interesting with some East Coast stuff with co-ops and things. But regardless, we look it over. And I look to make sure that the people I'm dealing with are the vested parties. All of a sudden it's like, oh, what's this trust? What's this LLC? Who's in this LLC? Oh, who's that? Why do you have your kids on here? So there's sometimes that we need to do some cleanup. Which we do. We can help deed things on and off. Those are those legal services incidental to an exchange that we can do, but that most exchangers can't because they're not licensed attorneys. So anyways, broker's role, identify the issue early on, alert their seller, and keep us in the loop.
So to summarize that, you thinking, again, just not advising the client to seek the advice early before the whole transaction even starts?
Yeah, absolutely. It doesn't hurt. You don't have to do anything special with your purchase and sale agreements if you're using the standard form multiple listing. It's already there. We used to have to give an addendum each and every time, and little triplicate ones, and you'd pull them apart. But I'm glad that the multiple listing service just added that one paragraph exchange cooperation language. And so there's nothing you have to do special as far as drafting the contracts.
So what should a great broker be doing differently maybe after the sale to really protect the client?
I mean, the broker's role is to sell the property, and then if you're a buyer's broker, is to find property. I suspect your lawyers would tell you to stay in your lanes a bit, but we take care of the after. What we do once the exchange is complete is we put together a whole package for your CPA. Here's all the documents you need on your replacement side. Here's all your exchange documents. And you got your relinquished property. So we hand over to the accountant an entire package. It's all electronic now, but they get their little electronic folder with everything they do. You drag and drop, give it to the accountant. The accountant has everything they need to do up their the reporting form, the 8824, and the exchange is done. Taxes are deferred, and then you start talking about the next property with your client.
So basically buy them a closing gift and one for your intermediary too.
There you go, right there.
I always fumble saying that, intermediary. All right, hey, next section, we're gonna do a little rapid fire.
Okay.
Biggest 1031 myth you hear?
That it's a tax-free exchange.
Weirdest exchange scenario you've seen?
Oh, selling multiple properties and trying to buy multiple properties.
If investors remember just one rule, what should it be?
Talk to us early.
There you have it. So before we wrap up, you'll see that QR code one more time. If you're planning a move, thinking about selling, considering an investment, or just want to talk through options, that link gives you a simple way to schedule a conversation with us. No obligation, no pressure, just a chance to ask questions and see if I can be of service. And if this episode was helpful, please subscribe, share it with another investor, drop a comment below, or if you've done a 1031 exchange or thinking about one, let's talk. Because the best time to learn this is before you sell. So real estate is one of the greatest wealth building tools in the world, but long-term winners understand strategy, not just transactions. 1031 exchanges aren't shortcuts, they're discipline, they're planning, they're playing the long game. Huge thank you to Martin for sharing his experience and insight today, and to everyone watching, build smart, plan early, and protect your wealth. We'll see you in the next episode. That was outstanding, my friend.
Okay.
Thank you so much.